Today, I want to introduce you to the stock market and the wonderful world of investing. As usual, I'm not an expert in this area, just a fellow traveler who's read a lot over the years and has dabbled somewhat successfully in this hobby. I won't be able to offer any personalized investment advice or give you any hot stock tips. In fact, you should be wary of anyone who does offer hot stock tips or tell you exactly what actions you should personally take with your portfolio. They don't necessarily understand your goals and what your portfolio is balanced for. They're in no position to offer you concrete advice. Why do I like investing in the stock market? There are a few reasons. First, in other domains like philosophy, religion, history, etc., you can argue about your positions for your entire life, or even longer if you write a lot, and not really know if you're right. Not if you're being honest and understand knowing as something other than an emotion. But in investing, if you're right, you make money. And if you're wrong, you lose money. Another reason I like investing is that it's a place to practice applying our knowledge of cognitive biases. Keeping your emotions under tight control is critical in investing. Think about the following common experience. A stock you own or one you've been watching for a while goes up a lot really fast. Maybe some good news just broke and the market is reacting favorably to it. How do you feel? Some excitement, perhaps? A bit of a thrill? Maybe a bit of fear of missing out? What if it goes up even further while you're admiring it from the sidelines? What does that make you want to do? Buy some? But think about it. If you buy now, after it's already run up in price, you'd be buying it after it's made those gains that were so exciting. It's more expensive now. Now consider another common experience. A stock you own drops all of a sudden. Maybe some bad news just broke and the market is reacting unfavorably to it. How do you feel? Stress? A little panic, perhaps? Maybe a bit of fear of losing even more? What if it does go down further while you're sitting there watching it burn? Maybe you could save some of what's left at least? The natural human instinct here is to panic sell. But think about it. If you sell now, after it's already dropped in price, you'd be selling after it's already lost that ground that was so painful. It's less valuable now. Remember the classic adage, buy low, sell high. If you follow your emotions, you'll end up doing the exact opposite, buying high and selling low. Tisk tisk. It is no way to save for retirement. On the contrary, a shrewd investor can use this basic insight to their advantage. If a company you own or have been watching for a while drops suddenly, and you read the news about why, and it seems like an overreaction in response to a temporary issue instead of a erosion of the fundamentals of the business, that might be a good opportunity to buy. After all, the value that you saw in the company before is still there. The price is just lowered now. In other words, that stock has just gone on sale. Don't you like buying things when they go on sale? This is what investors call buying the dip. This is the basis for another classic investing adage. Uh, this one, a concise distillation of Warren Buffett's contrarian approach to investing. Be fearful when others are greedy, and be greedy when others are fearful. One of the best resources I came across early in my investing journey is Jason Kelly's book, The Neatest Little Guide to Stock Market Investing, now in its fifth edition. I think I read the first or second edition back in the day. Now I'd like to share with you a few selections from that book. As always, there's so much more in the book that I won't be able to cover here today. In particular, I'm not going to touch on Chapter 4 about permanent portfolios or Chapter 7 titled This Book's Strategy. If what you hear today piques your interest, go pick up a copy of the book yourself and give it a read. Seriously, it's only about $15 plus or minus a few dollars, and that's nothing compared to the thousands or tens of thousands of dollars or more that you stand to gain from having the confidence to start investing in the stock market. After all, as the title of this book's foreword reveals, this book always works. But do keep in mind that a good rule of thumb is to keep your annual overhead expenses related to your investments at less than 2% of your portfolio. And that includes all education, research, commissions, fees, all of the overhead expenses. As usual, the author uses the first person once in a while in their writing, so when you hear me say I or me, that is Mr. Kelly speaking. Okay, let's jump in at the beginning, where Mr. Kelly teaches us how to speak the language of stocks. Anybody can make money in the stock market. By picking up the phone or turning on the computer, you can own a piece of a company in all of its fortune or folly without ever attending a board meeting, developing a product, or devising a marketing strategy. When I, Mr. Kelly, was 11 years old, my grandfather explained to me in less than 10 seconds why he invested in stocks. We sat by his pool in Arcadia, California, and he read the stock tables. I asked why he looked at all that fine print on such a beautiful day. He said, because it only takes $10,000 and two 10-baggers to become a millionaire. That didn't mean much to me at the time, but it does now. A 10-bagger is a stock that grows tenfold. Invest $10,000 in your first 10-bagger, and then you have $100,000. Invest that $100,000 in your second 10-bagger, and you have $1,000,000. That, in less than 10 seconds, is why everybody should invest in stocks. You should know why stocks are good investments before you start investing in them. There are two reasons to own stocks. First, because they allow you to own successful companies, and second, because they have been the best investments over time. Stocks are good investments because they allow you to own successful companies. Just, just like you can have equity in your home, you can have equity in a company by owning its stock. That's why stocks are sometimes called equities. Think of all the rich people you've read about. How did they get rich? Was it by lending money to relatives who never repay? No. Was it by winning the lottery? Not very often. Was it by inheriting money? In some cases, but that's irrelevant for our purposes because nobody has control over that factor. In most cases, rich people got rich by owning something. That something might have been real estate. You learned the first time you watched Gone with the Wind that land has value and that owning some is a good idea. In most cases, though, people get rich by owning a business. School children learn about John D. Rockefeller, Andrew Carnegie, and J.P. Morgan. They all owned businesses. Henry Ford sold cars. Ray Kroc sold hamburgers from McDonald's. Thomas Watson sold business machines from IBM. Steve Jobs sold iPhones from Apple. Scott Cook and Tom Fruhl sold financial software from Intuit. Howard Schultz sold coffee from Il Giornale. What's that? You've never heard of Il Giornale? Oh, but you have. Just not by that name. Schultz rebranded it Starbucks after buying the company from its original owners in 1987. All these people owned their companies. I sold magazine subscriptions door to door in school to raise money for the student council. I didn't get rich because I didn't own the subscription company. See the difference? I could have taken some of that money I earned pawning off another copy of Reader's Digest on Mrs. Klein and bought shares of the subscription company. Suddenly, I would have been a business owner, encouraging my classmates to sell, 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 even if it meant that they would win the portable radio instead of me winning it. The business they generated would have improved the subscription company's bottom line, and as a shareholder, I would have profited. If all went as planned, I could have bought a dozen portable radios. That's why owning stocks is a good idea. They make you an owner of a company, not an employee or a lender, an owner. When a company prospers, so do its owners. That's cute, you're thinking, but does it really work that way? Let's take a look at history in a few hard numbers. The stock market has returned about 10.5% a year for the past 75 years or so. Corporate bonds returned 4.5%. U.S. Treasuries returned 3.3%, and inflation grew at 3.3%. Notice that Treasuries and inflation ran neck and neck. That means your investment in treasuries returned nothing to you after inflation. When you include the drain of taxes, you lost money by investing in treasuries. You need stocks. Everyone who intends to be around longer than 10 years needs to invest in stocks. That's where the money is. So this is how you make money owning stocks. This is really the bottom line to investors. The only reason you own a business is to profit from it. The way you profit by owning stocks is through capital appreciation and dividends. Sometimes called capital gains, capital appreciation is the profit you keep after you buy a stock and sell it at a higher price. Buy low, sell high is a common investment aphorism, but it's just as legitimate to buy high and sell higher. Expressed as a percentage, the difference between your purchase price and your sell price is your return. For example, if you buy a stock at $30 and you sell it later for $60, that's a $30 gain, and that represents a return of 100%, doubling the money. If instead you sold it later for $90, you'd have a $60 gain per share, which represents a 200% return. Some other examples here that are kind of eye-popping. If you happen to buy Cisco in 1990 at 10 cents and sold it in the year 2000 at $70, your return was just shy of 70,000%. If you bought Hanson Natural in July 2006, excuse me, if you bought Hanson Natural in February 2003 at 40 cents and sold it in July 2006 at $50, your return was, somehow I mistyped that one, 12,400%. If you bought Green Mountain Coffee Roasters in October 2008 at $6 and sold it in August 2001 at $100, your return was 1,500%. The goal is appreciation, but sometimes investors end up with depreciation by mistake. If you bought Citigroup in November 2007 at $35 and sold it in November 2008 at $6, your return was negative 83%. The other way to make money with stocks is through dividends. As an owner of a company, you might share in the company's profits in the form of a stock dividend taken from company's earnings. Companies report earnings every quarter and determine whether to pay a dividend and what the dividend payout should be. The company looks at the list of shareholders, and if you're on that list by what's called the ex-dividend date, you get a dividend check. The company decides how much the dividend will be per share, multiplies that by the number of shares you own, and deposits the total amount into your brokerage account. If you own 10,000 shares and the dividend is 35 cents per share, the company will deposit $3,500 on the payment date. It's that simple. The money you make from a stock's capital appreciation combined with the money you make from the stock's dividend is your total return. Just add the rise in the stock price to the dividends you've received in the meantime, and then divide by the stock's purchase price. For example, let's say you bought IBM at $45 and sold it 2 years later for $110. IBM paid an annual dividend of $1 in the first year and $1.40 in the second year. The rise in the stock's price was $65. The total dividend paid per share was $2.40. Add those two, and you get $67.40. Divide that by the stock's purchase price, which was $45, and you get 150% total return. Companies want you to buy their stock so that they can use your money to get new equipment or develop better products and expand their operations. Your investment money strengthens the company. But first, the company needs to make its stock available. This section describes how. The magazine subscription selling job I held in school made me think a lot about becoming a business owner. I imagined teaching all the other kids how to sell subscriptions, collecting their money at the end of the day, using some of it to buy a prize for the top seller, sending a small amount to the magazines, and depositing the rest into my bank account. Pretty simple business model, right? Pretend for a minute that I did it. Maybe I called my business Mr. Magazine. I realized early on that Mr. Magazine needed office space. A treehouse would do. I needed lumber to build it, and I needed electricity and phones installed. That takes money that I didn't have. After all, that's why I went into business, to make money. If I already had it, I wouldn't have needed to go into business. There are two ways I could have raised money for Mr. Magazine. First, I considered a business loan from my local bank. Could have drawn up a business plan and pleaded with my local loan officer. When I showed them the sketches of corporate headquarters and a tree, my guess is that our interview would have been quite short. A lot of fledgling businesses face just that problem. They aren't established enough to get a loan, or if they do get one, it comes with such a high interest rate to offset the risk that it ends up strangling the business anyway. Nope, a loan wouldn't do it for Mr. Magazine. My second option was to sell shares of Mr. Magazine to investors who wanted a piece of the upcoming profits. By selling shares, I would raise money, I wouldn't owe anybody anything, and I would acquire a bunch of people who really wanted Mr. Magazine to succeed. They would own a part of it, after all. I chose this second option to raise money, and I decided that 10 shares comprised Mr. Magazine's entire operation. I could have chosen 100 shares or 100,000 shares. The number doesn't matter. The only thing that investors care about is what percentage of Mr. Magazine they'll own. I decided to keep 6 of the shares for myself to retain majority ownership and sell 4 shares to parents in my community for $100 each. Those parents were my venture capitalists in this case. After the sale, I owned 60% of Mr. Magazine, and the 4 parents in the community owned 40% combined. It was a private deal, though. You couldn't find Mr. Magazine listed in the paper yet. The first year of operation at Mr. Magazine went great. I hired 20 kids to sell magazines door to door. I negotiated a cheap deal with the magazines, and I found a wholesale prize distributor who sold gadgets for half their usual price. My employees were happy, and Mr. Magazine grew to be worth $5,000. How did my investors fare? Quite well. Those initial $100 shares became $500 shares in 1 year. That's a 400% annual return. Clearly, there's only one thing for me to do. I needed to immediately drop out of school and expand Mr. Magazine to outlying communities, and then the entire United States. It was time to come down out of the treehouse and establish the ground-based headquarters, evolving as a business just as humanity evolved as a species. To fund this ambitious expansion, I decided to take Mr. Magazine public. Instead of selling shares to just 4 parents in my community, my next step was to sell Mr. Magazine to millions of investors by getting listed on a stock exchange. Stock exchanges provide a place for investors to trade stock. The most famous from US history are the New York Stock Exchange, the American Stock Exchange, and the National Association of Securities Dealers Automated Quotations, otherwise known as NASDAQ. Here are some of the listing requirements on the biggest exchanges. I'm not going to actually go and read these out loud. You can just sort of notice that they're here. Scanning over them, obviously, Mr. Magazine didn't have a prayer of making any of these 3 big exchanges. But let's say that a colossal exception was made, and I worked with the investment banking side of a large firm like the Bank of America, Citigroup, Goldman Sachs, JP Morgan Chase, or Wells Fargo to make a initial public offering, or IPO. I told the investment banker how much money I wanted to raise, and the banker determined how many shares to sell and at what price. I wanted to raise $10 million. The banker could have sold 5 million shares at $2 each, 10 million shares at $1 each, or 2 million at $5 each. As long as the combination produced the target amount, it doesn't matter. The investment banker committed to buy the shares if nobody else did, and got to keep a small amount of profit per share for taking on this risk. The banker initially sold shares of Mr. Magazine to the primary market, which consists of the banker's preferred private accounts. After the primary market had dibs on the tantalizing new shares of Mr. Magazine, the investment banker offered the remaining shares to the secondary market, which consists of everyday schmoes like you and me who read a stock's price in the paper or online and buy it. Once the banker made the initial public offering, I had my money and a bunch of new investors in the company. When it came time to raise more money, I sold additional shares of stock in what's called a secondary offering, in contrast to the initial public offering. No matter how many additional times I sell more stock, it's always called a secondary offering. I would also have the option of selling bonds to investors. When an investor buys a corporate bond, he or she is lending money to the corporation and will be paid back with interest. That means bonds have the same drawbacks that bank loans do. Mr. Magazine will be forced to pay interest on the money it borrowed from investors instead of just selling them a share of stock in the company. Secondary offerings are sometimes necessary because companies don't receive a dime in profit from shares once they're being traded on the open market. After a company issues and sells a share of stock, all profits and losses generated by that stock belong to the investors trading it. Even if the price of the stock quadruples in value and it's bought and sold 10 times in a day, the issuing company doesn't make any money off of it. The reason is simple. The investor who buys a share of stock owns it. He or she can sell that share for whatever price the market will pay. The company isn't entitled to any of the profits from that sale because the investor is the sole owner of that share of stock, and whoever buys it next then becomes the new owner. Unless the company buys back its own stock, it won't own the shares again. It's no different than you selling your car. Do you owe Ford a share of the sale price when you finally get rid of that old Pinto in your garage? Of course not. You place an ad in the paper, deposit the buyer's check, and go on your way. It's the same situation if you own shares of Ford Motor Company. You place the sell order, take the buyer's money, pay a brokerage commission, and go on your way. Ford doesn't even know what happened. Evaluating stocks is actually quite easy. Once you've done it a few times, you'll develop a pattern of research that you can repeat with every new stock that interests you. There is a lot to learn, and we won't have time to cover much here, but I did want to at least introduce the concepts of growth investing versus value investing. This is the most basic division between investors, akin to North and South. But like North and South, there's a lot of area between each extreme that's hard to classify. Think of growth and value as being on a continuum. Most investors fall somewhere in the middle, and combining the two styles has proven to be a great investment approach. Growth investors look for companies that are sales and earnings machines. Such companies have a lot of potential, and growth investors are willing to pay handsomely for them. A growth company's potential might stem from a new product, a breakthrough patent, overseas expansion, or maybe excellent management. Key company measurements that growth investors examine are earnings and recent stock price strength. A growth company without strong earnings is like an Indy 500 race car without an engine. Dividends aren't very important to growth investors because many growth companies pay small or no dividends. Instead, they reinvest profits to expand and improve their business. Hopefully, the reinvestments produce even more growth in the future. Growing companies post bigger earnings each year, and the amount of those earnings increases should be getting bigger too. Most growth investors set minimum criteria for investing in a company. Perhaps you'd like to see it growing at least 20% a year and pushing new highs in the stock price. Growth companies you might be familiar with include Applied Materials, Boston Beer Company, which is Samuel Adams' brand, Chipotle Mexican Grill, Google, and Vera Bradley. Now that you know, now you know what people mean when they drive past yet another Chipotle and say, that place is growing like a weed. Growth investors are searching for hot hands, not great bargains. They'll pay more for good companies. As a result, many growth investors don't even look at a stock's price in relation to its earnings or its book value because they know a lot of growth stocks are expensive and they don't care. They just look at the stock's potential and go for it, hoping that the current successes continue and get even better. They buy momentum, inertia, steamrolling forward movement. That's the nature of growth investing. William O'Neill, a top growth investor whose strategy you'll learn later in the book, says in his seminar that growth investors are like baseball teams that pay huge salaries to top-ranked batters. They come at a high price, but if they keep batting 300 and winning games, then it's worth it. Likewise, you won't find many bargains among growth stocks, but if they keep growing, it's worth it. Because a growth stock depends on its earnings and acceleration of those earnings, the expectations of analysts and investors are high. That creates a risky situation. If a growth company fails to deliver the earnings that everybody expects, all hell breaks loose. Red flags fly left and right, phones vibrate madly, the stock price falls, reports shoot from fax machines and fill up email inboxes, and nobody's dinner tastes quite as good as it did the night of last quarter's earnings report. Value investors look for stocks on the cheap. They compare stock prices with different measures of a company's business, such as its earnings, assets, cash flow, and sales volume. The idea is that if you don't pay too much for what you get, there's less chance of losing money. Value stocks have low PE ratios and low price to book ratios. They're companies that have been overlooked on their journey to success, have fallen on hard times after more successful years, or are in a slump for any number of reasons. Hopefully, they're on a comeback, and the value investor purchased shares at the bottom of an uphill climb. Here's where value and growth are tied together. In both cases, investors want to buy companies with a bright future. The difference is that growth investors usually buy those companies when they're already steamrolling ahead to that bright future, while value investors usually buy those companies when they're still getting ready to start or are recovering from a tumble. Using O'Neill's baseball analogy, value investors comb the locker room for bandaged players trying to rehabilitate. They don't cost much, and you might uncover a future star. Of course, you might get exactly what you paid for, a broken player or a broken company. For the value investor is a bargain hunter extraordinaire. From my interviews with professionals and novices alike, I gather that value investing is closer to what we've been taught from the time we were kids. What did you look at when buying candy? Probably which kind you could get the most of for your pocket full of allowance money. In school, you probably bought the package of notebook paper with the most sheets for your dollar. We're used to examining price with an eye toward value. It's no different in the world of investing. Value investors pay particular attention to dividends. A company that pays dividends contributes to an investor's profit even if the stock price doesn't rise. That's comforting. Also, among big companies, the dividend yield is a great indicator of how bargain priced a company is. Growth investing and value investing are not mutually exclusive. Many growth investors use some measure of value to time their purchase of growth stocks. Most value investors use some measure of growth potential to evaluate a troubled company's chances of recovery. Growth investors tend to get in when things are heating up and bail out at the first sign of slowing growth. Value investors tend to be very careful about where their money goes and let it ride out fluctuations once they decide where to invest. The contrast in these two styles is why I think value investing is more suitable to the average individual investor. Most individuals do not have the time or resources to monitor split-second changes in their stocks and act accordingly. It seems that conducting thorough research periodically and letting the chosen stocks do their thing is the best approach for most individual investors. That being the case, why go through all the hassle of all the trading that accompanies pure growth portfolios? Those are Mr. Kelly's thoughts only, and throughout this book, he tries to provide equal space to each style. Most of us end up combining the styles in our personal portfolios with a tendency one way or the other. Mr. Kelly reports that he has enjoyed excellent results from both growth and value investments, although he tends towards value. And as much as it pains me, I'm going to have to leave it there for today. There's so much left on the cutting room floor, and we haven't even touched on what all those metrics actually mean. But I also wanted to make sure I didn't cover too much information that'll just make everyone's eyes glaze over and make you want to take a nap. So with that, I think I will leave it there and open the floor for discussion and questions.